Happy Friday, everybody. Welcome to another episode of Real Assets with Jimmy. Today is Friday, the last day of quarter end markup, and March 31st here, 2023. With me, as always, Jimmy Wang. Jimmy, good to have you.
Good to see you, Turtle.
Good
Happy
to
Friday,
see you.
man.
Yeah. And we have a special guest, Robert Heimowitz. I hope I said that right. He works at a fund, covers real assets. And we'd love to have him on the show. It's our first guest here on Real Assets with Jimmy. So very pleased to have you, Robert, and excited to get into it with you. Today, we can really talk about what Robert specializes in, which is home builders. And, he covers real assets. So this is good, good conversation, a lot of moving parts out there. And I think this will be a fun conversation. I think the real point here is hopefully the viewer would get some thoughts on thinking through the secular versus cyclical setup in home builders, and maybe just taking away kind of like what's that Patrick O'Shaughnessy, like he does like the deep dive, like just kind of an industry download. Like here's some threads to pull on and some starting place if you're like me, not super familiar or comfortable with the home builders.
If you're new and you just want to dive into home builders, right, with their double-digit yields, that's good.
Yeah, exactly.
Stay away from Apple.
Yeah. So Robert, thanks so much for coming on Real Assets with Jimmy. How are you?
I'm great. Thanks for having me.
Yeah. Good, my man. Good. So yeah, before we get too into it, let's pull up some charts, which we just had. And let's go, before we get too into it, tell us a little bit, Robert, just the high level, where who you are, what you do for a living, and kind of what your day-to-day existence looks like.
Well, I started my career at investor relations at a large home builder. Have since moved over to the buy side at a local shop down in Miami, in the same city. And, I moved over as a research analyst, and, I tried to add value immediately because the place where I work has had a need to deploy capital. So I took my immediate area of expertise and have been able to give them a lot of great real estate ideas for the portfolio. And yeah, I've had the opportunity since then to also expand out and learn some new industries as well, which I've really enjoyed. I've also actually do a little trading for the firm as well. So that's also really exciting. It's a new avenue to explore. It is mainly order execution. I'm not making big macro calls. I'm not going to be a hero prop trader any day, but I get to have some latitude to save an eighth or a quarter here, and it's fun. And you see the brokers trying to push people around, and you got to push them back. So it's been a good experience.
That's fascinating. How do you think about how is it that you came in you started working in IR for a home builder? So that would make sense, but why a home builder? Like did you have an interest in, real assets, real estate, finance, all that, like coming out of college and stuff? Or how did you find yourself working at a home builder?
So I was interested in the finance aspect. It's funny being in Miami, like before, like half the world discovered that Miami's great. Like it really was like, I would joke like 80% of the economy was real estate, whether it was lending or developing empty apartments that no one occupied and that foreigners from Russia or Venezuela owned. It was just like the whole economy in Miami was real estate, and everyone thought like, oh, he works at a home builder, he must love real estate. But I came at it more from like a finance angle of just loving that side of things, actually.
Yeah, that's cool. Yeah, on the nightstand right now, I've got this book, Bubble in the Sun. It's about like the 19 teens bubble in Florida, one of the original like housing bubbles, and how important, I guess I haven't finished it, but the read through is like how important that was, kind of an underrated factor as far as the how intense the depression was like how much money was eviscerated in the property bubble there in Florida. So it's a good one. We'll have to do we'll do Real Assets with Jimmy book club on it sometime.
Yeah. Hey, Robert, did you see any, you talk about the Miami being a real estate city. I'm sure on a cash basis, when you look at stuff that's done under the table, there's even more of that. Like in your time, did you see any crazy stories, any any shady deals, any with international capital? What was that
So
like?
it's not necessarily a well-kept secret anymore, but when the Panama Papers came out,
Yeah.
I was just getting started, and it came out that, like, politicians were the number one group of people who were hiding money. And people had knew this already, but like around Miami, like there were huge like towers of buildings with tons of units that were owned by the president of Panama. And it's like, where did he get all this money? It's like from the people of Panama. So, yeah, definitely a big theme here, and there's a lot of Russian money here too. So I can't say that I know anyone particularly, but yeah, you can bet that there's a lot of stuff that goes down.
And it definitely adds an interesting dynamic, right? Anytime you work in an international city where the flow of capital is as such, it's the interplay between interest rates and the domestic economy, the real economy, it's a lot more convoluted. And the marginal buyer and seller tends to be a lot different. So you have some interesting dynamics that, either glue these markets together or make them fall apart. When you have FERPTA and you have other types of issues that, create demand or supply shocks.
Yeah. And it's interesting because for a long time, everyone said, like, what's going on in Miami is not sustainable. It's not sustainable. And I mean, I was one of those people. I didn't agree that it was sustainable to just build empty apartments. And now they're all filled up, all of them. Like, it's hard to find. And the rents have went up.
Bankers got paid, the developers got paid, the subcontractors got paid, and the people are either hoarding cash or they got their units. So, for now.
Love it. So let's get into it. I'm sure for you, it's kind of like, it's like explaining something that you look deep at the details to at a 30,000 foot level sometimes can be difficult, but maybe help us understand kind of the landscape of the competitive environment of home builders in general, how to maybe think about home builders as a sector, if you will. I think it's a level 2 gig sector, right? And how to think about it as a portfolio, from a portfolio construction standpoint. Do you, or I guess, I mean, start here. I mean, do you spend any time thinking about it I would say this, ITB, XHB, the home builder ETFs, it seems like that's really thought of as a trading sardine, right? It's really thought of as something you want to get long at certain points in the cycle, get off at other points in the cycle. It's not really thought of as something that you can hold through cycles. Do you think that that's a fair characterization? And how do you think about that?
These businesses are in the best positions they've ever been in, frankly. It's not a particularly competitively constrained environment. People can enter and exit at will. It's not hard to, but some of the larger public players definitely have competitive advantages. What I would say that these businesses are, like I already said, they're in the best position they've ever been in, but that, like, you don't need to be a hero and, like, if you see interest rates ripping in your face and hold it just because they're in the best position ever. Like the Wall Street banks, when they found out the Feds was gonna raise rates, they all cut their estimates and all said to sell the stocks, and the stocks sold off pretty strongly. So there's no reason to be a hero. They have since rallied, so there was a very strong opportunity to get in there. And the stocks, when earnings were peaking, and rates were still low, we're starting to sell off the highs. So, the market kind of looked through that. But now with rates high and sales are actually a little slower, it feels like the market's looking through it and saying, like, if the Fed starts cutting rates and the 10-year moves down, we might see activity pick up. So, from this spot going forward, they actually, it's a pretty interesting spot to pick them, because they already saw that huge sell-off, and rates don't look like they're going higher.
That's a really good insight. I think when I look at the home builders in the broader portfolio context, the interest rate sensitivity has been unreal, right? A lot of the times it is an interest rate trade. And from my time covering and investing in some of the home builders, I always anchored to price to book. I know that's a moving target. It's changed. There's different reasons to think about peak price to book multiples and trough ones, but maybe can you explain how maybe that's evolved over the years, or kind of, when you do your deep dive into these home builders, where do you start? Where do you start? Do you look at their properties? Do you look at the company balance sheet? Do you look at technicals at first? Tell me more.
I do not look at the individual properties. I would call it walking the community.
Mm-hmm.
Like when they have over 1,000, even ones with hundreds. Like you can just pick more around geographies in general, and without walking them. But what I would say is that I start at a very high level with strategy. Like the ITB maybe doesn't do the different types of interesting factors that you can play to in the builders justice, because you have your custom builders who wait till they have an order, and then you have your more process oriented builders who say, we're going to deliver as many homes as we can, and we're going to move the margin and the pricing that we get to reflect how many homes we want to deliver. And that really helps those builders leverage their SG&A. Whereas the custom and build to order builders are really managing the margin. And you'll see, if you look at any of their earnings releases, they've really been hammered. Their orders have really lagged, and they're just giving up share. And it turns out that these are the incremental deliveries. When the buyers come back to the market, they will be the incremental delivery. They won't be the delivery that's guaranteed to happen. They need better times in the market to see their business. And if you're a home builder and you're not building homes, like what are you doing? So that's just my point of view. To the price to book comment, I would start with, that's kind of what investors use to judge their downside. When builders start to get bullish, or rather when investors start to get bullish on the builders, they come back and they start looking at the price to earnings multiple. So the price to book can be seen as a floor. And I've seen plenty of investors say that, like these things can trade beneath price to book. They can stop using the 1.0 price to book multiple as a floor. And frankly, those investors who say that are not looking at the fact that there are small caps trading at price to book discounts, like major ones. But like the major builders who say we're going to build and we're just going to deliver as many homes have actually seen that floor been pretty good. They might have fell through it for a little bit, but for the most part, it's been a pretty strong floor.
I think that's a really good comment. So thanks for telling our viewers that. I've covered some international home builders too, where they fall below 1 on the price to book ratio for other reasons, right? There could be liquidity discounts, there could be balance sheet considerations, minority ownership reasons. So I think that's been a moving target. But I think your point about upside downside, when people are dreaming and they're hopeful and they're looking at profits in arrears, they want to go to the PE to kind of think about the upside. But especially when we talk about cyclical versus secular, that front running, not wanting to pay trough or peak multiples for peak earnings, and then vice versa, is an interesting dynamic. Where would you say we're in the cycle right now? I think thematically it's easy to say, hey, we're in the late innings. We're seeing costs come up. We're seeing the rates come up. We're late in the business cycle, the labor cycle, the credit cycle. But some of these larger names, they're still around. They're not bankrupt. They're gonna see it through. So how would you put them in that context today? Like, where are we with the home builders and some of those different factors?
So I would start by saying that costs are coming down. That's the number one thing. They're coming down across the board. And besides land, right now, land is the one thing that's been sticky, but labor, all the people that built out capacity to deliver more building products, now everyone's like, I built this capacity and now I need to compete for every last unit, I think. So you see the building products inputs and the labor inputs coming down, which helps with the margin. Even if the actual price goes down, the percentage might not. I mean, they have been going down.
Yeah. Is that a new phenomenon with land? Because land used to be the first thing that went up and first thing that went down. But I don't know if it's labor related or input related this cycle? Are you seeing something
I
different?
would say that is somewhat of a, maybe it's because it's a real asset. Everyone likes to talk about real estate and talk about the interest rate sensitivity, and that's extremely important. But sometimes they forget that we're dealing with a real asset, and like we've seen all real assets go up. So that might be a reason why it's a big time.
Sure.
As to where we cycle, you know, in the summer of 2020 through 21, you start to see all the builders start ramping up their land spend in a huge way. And they've been doing it in a different way, though, where they're optioning more land, which means that if they walk away, they don't lose as much money. And now we're seeing them all be much more selective around their land spend. A lot of the builders showed during COVID that they can pause their land spend and they could push out the closing dates and they can manage the cash flow very well. In fact, 2020 was a very good cash flow year for a lot of builders. So I think we've seen just a much more resilient business model than people are used to. Another thing to just keep in mind is so many people fight the last battle. And as bad as COVID was, it was like a month or two drawdown before it ripped to the upside. There was no truly systemic financial damage. Obviously, like the lockdowns were economically harmful, but not necessarily harmful to the financial system. And so when everyone thinks about a great financial crisis, not an economic crisis, a financial one, the first thing they think of is, well, the home builders got crushed. Well, home builders were the center. They were the eye of the storm last time. That's not happening this time. Yeah. So they're much more ownable in this environment, in my opinion.
That's a great comment. I mean, Charlo and I, we talk about all the time how, like, in periods of crisis and stress, people revert to the old playbooks, right? That 07, 08, 09 playbook is a lot different than the current situation we find ourselves in. But yeah, good to know.
Maybe you can dive a little deeper help us understand the optioning land component. So yeah, and how is that something that they've done forever, or is that something that they've done post GFC, or like talk to us a little bit about the optioning land component as a home builder?
So it's always been a feature, but it's become much more popular as of late. It's basically like you sacrifice some gross margin because when you option land, you're basically paying a premium to the seller in a lot of ways so that they'll hold the land longer. And so they agree to a higher sales price. But what ends up happening is that you don't have to outlay the cash to the seller until you're ready to go vertical, which means start building the home instead of, taking down the land, taking 2 years to put in roads and sewers and all that stuff. And so the returns on capital actually go up even if margin goes down. Because, the best way to think about returns, frankly, it's a DuPont formula. You have your asset turns and you have your margin. And so when all you think about is margin, sometimes you forget to manage to the asset turns. And so, like, as they've all been managing more to turns, and there's an extra benefit here, and it's not necessarily repeatable for indefinitely, but it can be repeatable for a few years at a time. But as you sell land that was on your books for 2 to 3 years while you were developing it yourself, you don't have to replace that full spend. Now you're only taking 10% of the land cost to invest in the future land. So now you're producing all that extra cash. You have a 90% extra cash flow. And what you can do with that is you can decide, hey, I'm going to build even more homes, or I'm going to buy back shares, or I'm going to pay down debt. Or you might say, I actually think that I add value through development, and you might not do that option. But what the option lot does give you the flexibility to is it's like a 1-time or 2-time working capital adjustment. So you actually produce cash as you move from being, like, let's say 100% land to 50% options. So it's actually been very helpful to the builders.
It's kind of
Robert, yeah, go ahead.
Well, it's kind of like a call option. I mean, is that an oversimplified way to look at it? You're buying a call option on the land, essentially.
No, absolutely, that is what you're doing.
Yeah, and so for example, I was looking at a development up here. I think Toll Brothers, and so my understanding is like Toll Brothers, because they're like they deal with more like tier 1 properties, less or more desirable land, and so they're less able to do so back to your custom builders versus process builders, they don't do any, or they do very little more optioning of land. Is that fair? Is that true?
Like, not in as much of the nitty gritty on tall as they used to be. But, you know, they have a product, I think, called T Select, which is on the edges. It's like a higher move up product. And so like basically what they do is on the edges, they build more like simple homes that are still nicer than your average home, but that they would be able to get faster turns on and maybe some less customization. So, you know, they'll still let you pick the color of the countertop, but they might not let you move an outlet. But like basically the point I'm making is that they're able to do it on the edges, and they're definitely trying to option. But I definitely agree with you that like for their core franchise, they're not going to be able to, like, they're going to agree to the terms that get them into the best parcels.
Yeah.
Turtle, what Robert said was really insightful. And again, for viewers who are not knee deep in real estate or home development, it kind of goes back to the PEPB discussion, right? When you think about where value is created, if you, me, Robert, if we went three-way in on one particular deal, of course we're going to want to buy with the lowest basis, with the greatest margin of error, with the greatest upside, if we have the capital for it. So, but at the same time, public companies have earnings to think about, right? And so there's earning dilution from buying something at a really good or low basis, but then having to go through getting all the certificates, getting the rights, and realizing that value. So you're carrying something that's not yielding, cash flow on your balance sheet today. It's going to depress your earnings. So if you think about these larger companies in aggregate, they have a steady development pipeline. It's X% of their portfolio. They've got yielding assets, or they have this recurring churn that they're going through. It's something that has to be managed, but at a lower level, particularly when it comes to multifamily, when it comes to storage. If we think about where the NAV is created, getting that certificate of occupancy or getting that land right, that could be 80% of the value, right? But there's a different type of investor who's trying to do that versus the larger guy who wants to say, hey, plug and play, ready to go, ready to deploy capital and earn a return. It's a different dynamic. But you can see how like you marry this dynamic to the cyclicality of real estate, and you find people that hit home runs, and you find people that get completely blown up at the wrong time.
Yeah, and you're seeing more of that in right now, specifically where all these people got super cheap capital and they wanted to buy in place rents, and they didn't underwrite any that go wrong. I'm not saying a pandemic coming, but getting a lower cost of capital doesn't mean that the building should be worth more, frankly. And they let themselves zero margin for error. And frankly, the home builders, it's good that like they are able to option land and that they were making that pivot anyway, because we were kind of seeing like people start to bid up land prices pretty egregiously in 2020 and 2021 in a way that was like very pro-cyclical. And it seems like the gross margins were going to levels that were like 30%, which is very impressive and very unsustainable for the industry. So, it's not like that there's no risk of that ever happening in builders either.
Yeah. I'm trying to remember the guy that said that. It's like buy price to book, sell price to earning. You know what I mean? Like buy when it's like a multiple price to book, and then as people start talking about the price to earning, that's when maybe look to flip out of it. Let's talk about the one thing as a generalist, but that's being charitable. I mean, as a guy without deep expertise in any of these sectors, one thing you notice when you look at home builders is they generally trade at a low multiple of earnings, and they have low payout ratios and low yields on the dividends. That makes sense. They're very cyclical. Is that it? I mean, is there more reason for that, or do you have other insights on that? On those, the fact that
Yeah, I mean, I think you see definitely a lot of share buyback in this space, maybe more so than dividends. I think like D.R. Horton raises their dividend like every single year. Maybe not, it's not a lot, but they do it. But the primary thing is they all love to reinvest in the business. And to quote famous investors, I think Buffett said one of the qualities of a great business versus a good business is the opportunity for reinvestment. And home building is one of the best for that. Like you can always find another project to put your money in. And as we spoke about like the ability to own land. If you said I'm running out of investment opportunities, they could flip back to owning land and say, we think that we can create value here. And so home builders have a lot of opportunities to deploy capital in their primary business, which is building the home rather than buying back shares or paying out dividends. But, it is interesting. Like D.R. Horton, for example, has started doing a lot of single family rental, and they don't sell those communities until they lease them up. So they are actually attaching cap rates to those communities instead of selling them empty and then letting someone else rent them out. And that takes capital on balance sheet to do. You need to hold that cash or that lack of cash that you now have because you're holding a home, and now you have less available to pay a dividend. But guess what? You're creating value. You really are creating value for the shareholders. So it's sometimes a much smarter thing to do.
And no, that's very interesting. Maybe that's a great potential transition. Let's talk a little bit about D.R. Horton. That's one that we talked about a little bit in the DMs. You mentioned one thing you mentioned about D.R. Horton that really, and I'll tie this back to me because I love talking. Nothing I love talking about more is I tweeted something the other day about about some real assets conversation, and I said, here, what are some high quality land plays? And it's just like just trying to. This is what's so cool about Twitter is like the ideas that came back actually making this tweet, right? I'm just, it's a legitimate question, right? People talk about these stickers here. Be Well, I'm reading a book on Be Well, or actually an audio book on Be Well right now. And it's kind of like the water rights play company, but I guess it's really hard to even pick up the shares, and they're pretty shady, or not very shady is not the right word on a podcast. They're very private.
Illiquid.
Illiquid, private. And yeah. And but they have they have some crazy water right that goes, they have 15% of the Kings River, which is like a massive irrigation river in California. But
it's a real California talking point.
Yeah, I'm all about yeah. The book, by the way, this will be the second book on Real Assets with Jimmy book club. The King of California. Fantastic audiobook. It's like 20 hours long. I highly recommend it. It's a really interesting story of like cotton in the Central Valley, and basically the Dixie South coming to the Central Valley. And this guy J.G. Boswell, B-W-E-L, they still, the Boswell family still controls this Be Well stock. They're like a water rights play, and then everybody knows the end of the Big Short. That's Burry's like big trade, right? So everyone's talking about, so how do you actually put it on? I guess like Be Well is one of the ways to think about that. But blah blah blah. So, but one thing you mentioned, Robert, that was really interesting to me was that D.R. Horton had recently purchased what was it? Not necessarily water rights, but water reservoir assets out west.
Yeah. So they purchased, and if I mess up the geographies a little bit, forgive me, but it was called Water. They had water reservoirs or rights, whatever you want to call them, in Arizona, Nevada, maybe Colorado, and I'm not sure if there's some. Arizona's right next to California, but it's all based off of like these issues we've seen. I think the Colorado River. It's really, there's a lot of political issues around that, but basically, like to me, that screamed to me a team that has their eye on the ball. Right, they're not going to let anything stop them from building the most homes possible. And it's, I do love real assets. But it's not. I guess it's not a coincidence I'm on this podcast. Real assets to me, it's been so funny to me for so long. We've seen all these tech companies and all these other platforms, have so much value in the markets and scream higher. And I always said but all their revenue is advertising. And at the end of the day, when you're doing an advertisement, you're probably trying to sell someone a product, and real products have to come from somewhere. And so I've always had this real appreciation for real assets, and obviously D.R. Horton does too. So it's a water constrained region, and they're not going to be water constrained, I guess is the best way to think about it. I'm not sure how it will work with regulation, if they'll be forced to contract out that to other builders or not. I'm not an expert on that side of the things, but I just think it showed an astute management team. And they actually did it like in a really interesting way where they bid under where it was even trading, and they only needed 50% approval. And they actually did it at a time where the market was getting volatile. And so the price came to them. And like, there was no way that arbitrage guys weren't going to be like, like I can buy this thing and just vote to get like more than I paid. And like, there were a lot of shareholders who felt that they got shafted. Actually, it was a take under, and they did it in a really smart way.
Yeah, and that was a public stock. It was public stock. Oh, VWTR. That's what it was. VWTR. Like
Yeah,
that's fascinating.
And they used to be a small stock called Pico.
That's right.
And before they had home building assets. I think they sold to Century Communities years ago. So like, obviously, it's when you have big swaths of land, like there's always a lot of people who are willing to build homes on it and pull some cash out.
Yeah.
That's fascinating.
I can't help but I feel like I'm sidetracking the conversation. I'm looking at all these different tickers, right? All these different tickers that you pulled up. Do you guys see double tops?
Yeah.
Again, we talk about interest rate sensitivity. I do look at the technical sometimes. I wonder where we are at this juncture. I think in previous conversations we've talked about ITB, XHB, how there's like Home Depot. There's a lot of non-home builder exposure in these larger ETFs. So I do think, as far as capital deployment, separate from, let's say, higher yield debt deployment, like other than maybe the dedicated funds that invest in home builders, how do you think the marginal investor looks at home builders? Where's the retail guy? Where's the high net worth guy? Where's the generalist in the space? I think that's kind of more fascinating, especially at this juncture, right, in the broader economy. I wonder if they're having different conversations than the people who are much more plugged in, much more, in the space.
Yeah, in terms of getting generalists, it can be really hard. As a percentage of the S&P assets, home builders are very small. So it's like you're in a lot of ways asking someone to take career risk by overweighting them to a significant degree. You find some funds that get very chunky in them because they know the businesses well and they're comfortable with them. I mean, it's easy to get comfortable with a real asset that trades on price to book, and if you don't pay above price to book, like you feel like you can't really get hurt. But
where are they today?
Yeah, I mean
where's NVR today on price to book? I'm curious.
NVR?
Yeah, just because Terrell has that up right now. He had the chart up.
Yeah, I got it on here.
That's going to be
Go ahead.
That's its own beast. That trade the rest of the sector.
Looks like 5x price to book.
Is that adjusted?
Yeah, let's look at like LEN now or something.
Yeah, they've gone from like 1 and 1.7
on LEN, according to Koyfin. Not as good as the stuff Robert's got. Okay. Go ahead, Robert. He's not asking me, asking you. Go ahead. What?
Well, in terms of the double tops. Listen, I mean, I'm not a technical guy. I've tried in the past. It didn't work for me too well, to be honest. But yeah, I mean, I'd say that you're better off. You could find some builders that are trading at discounts to price to book if you look hard enough, and that they can make some decent investments. I'd say it's more the custom builders, but you might want to see an activist get in there and tell them, like, listen, like you need to be a special. You need to and this is a case study I can point to is Meritage Homes, MTH is the ticker. They had pretty poor performance going back like maybe 10 years, and they really shifted their business model. And they said, we're going to build less floor plans and we're just going to build more entry level homes. And when you do that, it's more of a spec model, which is short for speculative. And they started turning their capital a lot more. And so I think that the builders that are trading at the highest levels right now, I think I saw Toll it looked like wasn't as toppy as, let's say, Horton. I think there's more opportunity in the now. And so if you don't think you have a chance of being an activist, which most retail investors don't really have a good chance of, Toll which is willing to be speculative on the edges, but has a great franchise at the core, has always done a lot of share buybacks as well, does multifamily development, which is very high IRR business. It's a well-run company. And if you think that you have a better shot at a company that's a custom builder now than the spec builders who are more fully valued, I'm not going to tell you that that's wrong. In fact, I'd probably tell you that's.
Robert, let's get to a name that looks different that I think you said you like, which is who cares about everything else? You like it. That's what I'm interested in. But it doesn't look like the others, right? So here's Lennar, Toll, and then 4-star. It's 4-star, right? That's how you say it.
Yeah.
That it looks different. It's got a little different business model, and it's got some cross ownership with DHI. Break this one down for us and tell us, should I put my retirement account in it? What do you think?
Cross ownership. DHI controls it. It was a shell company that basically owned a lot of land in Texas. Starwood Capital Group, the private equity firm, put a bid out for it for the whole company. And D.R. Horton actually bid more per share, but only took out like 75% of the shares. And what they did is they turned it into a platform that would buy the land from them. So it would be off balance sheet from D.R. Horton's balance sheet. It would be on 4-star's balance sheet. And so this has been a program that they've employed to basically find a large-scale capital provider to them who they can option lots from. And so their plan all along has been to they raised debt once they built this platform for the company to fund its growth. And then they also want to sell equity. I don't think they plan on selling their equity stake. I think they plan on probably selling equity at a price to book multiple at some point down the road when they're given the opportunity to issue equity more than they paid. But this company has compounded book value at 13 or 14%. Don't check me out perfectly on the number. I last calculated that probably around Q3. I haven't been following the name as closely in terms of their updating a model, but I've been following their earnings. And so they're trading at I think 66% of price to book. So you're getting something at 2/3 price to book that compounds at 13 to 14%. And then here's the next piece. They deliver right now, I believe, I'm not sure if it's 1 out of 5 of all of Horton's lots or 1 out of 5 of all of their option lots, but Horton wants to take that to 1 out of 3. So even if I got one of those wrong, or I don't remember exactly if it's 1/3 of the total or 1/3 of the option lots, Horton wants to take up the portion of the business that they acquire from them. And so they do also sell to third-party home builders. But I just think it's an attractive chance to build a company that's gotten a lot of support from a parent company that took it from a little shell company with a little land in Texas to a national platform. And you're buying it at a discount to book value, right? Let's discount their book value by 20% right now. You have a margin of safety. So it's an interesting opportunity.
How do you think about the concentration risk with that kind of sponsor relationship, right? I think that the cynic would say, hey, they're kind of the canary in the coal mine. They're taking that first loss if something happens, and Horton doesn't want to take the earnings dilution, so they say, hey, we're not going to take the option. Maybe one could say that there's a structural discount on a price to book value or a price to earnings because of that. But how do you weigh some of these different factors in?
I do on head that where the from is that they're going to be left holding the bag if the cycle turns. But I think we are seeing first off that the cycle really is the downside is more in the commercial real estate space. I think for builders, something that's not as appreciated is that a fall in home price means an increase in affordability for the end customer, and that if you're focused on volumes, you want the price to go down a little bit so that people can get into the home quicker and you could move on to your next lot. If you're focused on volume, the price going down doesn't bother you much. And for 4-star, they're sponsored by basically the largest buy units. It's not even close in Horton. per year. And so, you have that dedicated team that, their goal is to deliver 90 to 100,000 homes, let's say, a year. I might have gotten their guidance wrong on that, but there's someone who's going to build in, let's say, if it's not this year, it's within the next 3 years, we'll probably be delivering 100,000 homes a year. You have that type of dedicated customer and support system. And, we have former big time executives at Horton who are running the company. It's not like they've really supported this enterprise. And so I think when you take that together with the Vidler water stake, you see a very focused DR Horton team that's dedicated to delivering as many homes as possible. And so I think that should give comfort that Forestar is a sustainable enterprise going forward.
I love
now
that,
with Horton,
yeah, that's helpful.
Now with Horton, the one thing, you're pointing that double top, they're probably trading at a little premium of price to book right now. I think Forestar is a sweeter spot, but damn, I would be lying if I said I'm not licking my chops to own some Horton with that strategic focus.
Yeah. And just before we get off this, the Forestar, the business model is different than the rest of these builders, right? They're really just building the lot out and then selling it. I mean, that's obviously this is day one stuff, but again, it's tricky when you're a fish in water. But so that's basically so essentially that's all they're really focusing on is the lot itself, and that's why probably the chart looks different, because it's a different business. Is that do you think that's true?
Maybe. I mean, it's tough to say. I mean, listen, at the end of the day, they're moving lots to production with home builders. I think there should be more correlation there than there is.
Yeah.
You're at their revenues, their earnings, everything has accelerated higher and the stock price has not really responded. So it does seem there's a disconnect. Maybe there's a trust there from the investment community that DR Horton could leave them holding the bag, as Jimmy pointed out, and as I think is a real concern. But realistically, I like it here. And yeah, I mean, I don't know that there's much more to say. They've got a steady customer who is focused on delivering homes. And hey, let's say that their ASPs, their average sales price of their lots goes down, but they still keep their volumes up. I don't see why this thing shouldn't trade at book value. I don't see them impairing too many lots.
Dude, I love that. In short, he likes the stock. I think that's a great place. And I think really as our first guest on Real Assets with Jimmy, I think you set it up very nicely for the viewer here, where it's like, here's a mega, a tier one, name to watch in DHI. Here's something a little more under the radar in FOR. And, I learned a lot in 50 minutes just talking to you about, relative to my previous knowledge on home builders. And I think we can kind of watch here this canary, if you will, and see how it plays out through this cycle. I think it's very interesting. I think, another thing Jimmy and I talk about is like the long-term demographics, and there are a lot of millennials, trapped out of the housing market in these West Coast cities, these expensive cities, especially. And, here's another kind of piece of the mosaic, right? Here's the companies that are actually building on the lots that are going to be the new builds that go into that, eventually maybe we can buy. So yeah, a lot of moving parts. I think that's a decent place to end it. Jamie, any other thoughts from you? And floor is yours. Robert, any closing comments?
I think this is a fantastic kind of first foray for a lot of our viewers who don't know a lot about home builders, might have some interest. Again, I think there is gravity to the economic cycle, to the labor cycle, to the credit markets. And that's something we all have to be aware about. I think for so many years I put on my analyst hat. I knew more about the company than anyone else, but at the end of the day, that was not going to either preserve my capital or help my clients grow their capital. I'm not the chartist, but clearly you can see where the market is voting to in terms of how they're allocating their capital. There's companies making or close to their all-time highs, revisiting their highs, and then there are companies that are making lower lows, where whether it's justified or not, whether it comes to pass or not, but there are concerns about where the cycle is headed. So naturally you see companies lose that shareholder base. So it's, again, philosophically, at the beginning of the cycle, some of these distressed names are going to be great opportunities beginning to mid-cycle. But at the end of the cycle, no matter how good earnings are, no matter how much value they add through the cycle, sometimes that rotation, that shareholder base rotation in these cyclical sectors is, I've underestimated that in previous years at my own peril. Let's put it that way.
Yeah. Robert, it's been a pleasure. Any closing comments? Thanks so much for coming on Real Assets with Jimmy. And yeah, but any closing comments from you?
Yeah, I guess I would just say that watching other people comment on the housing cycle, there's so many Cassandras that complain when prices are too high, but then when prices start falling, like if people can't afford a home, it's a travesty. If people start to be able to afford a home, it's a travesty because the people who own homes. And so, home builders are interesting. They're the incremental supply. As we see banks like Silicon Valley Bank collapse, like they collapse because RMBS values cratered, and like those loss in value of bonds to them is the gain of the American people who got those mortgages at 3% or even lower. So, home builders are the incremental supply, and, it's going to be interesting to watch it play out and to see if with rates coming in, if they can really start building up their business again. But just one more piece is that I didn't even mention is that, they can take a piece of their gross margin to subsidize interest rate pay downs at these aggressive levels that most other home sellers can't, so there's a lot that they have to offer. But yeah, also, as we saw when the rates increased, like you don't have to be a hero and fight the cycle, right? But if you think that rates are coming down, I'd say that's probably good for the builders. But thanks for having me, guys. I really do appreciate the chance to project all this knowledge that I've spent 7 years accumulating.
I love it. Thanks so much. And no, definitely we'll try to give Robert a follow on Twitter. I will link his profile in the comments on YouTube. It's HE_MOWZ. Great follow. The Swami score, got to close on this. I forgot to mention this at the beginning. The top rated thematic ETF we track, check out the Swami score. You can go to swamiresearch.com and put your email in, and you'll get a daily email with the strength of signal on over 250 ETFs across asset classes. And the strongest thematic ETF we track is ITB right now. It's the home builders. And so that's why we wanted to get the home builder whisperer, Robert, on the pod. And it's been a lot of fun. And with that, thanks for listening to Real Assets with Jimmy, episode 4. Have a great day, and look forward to talking to you guys again soon.
Great to see you guys. All right.
Absolutely.
Having an awesome end to the first quarter.
Yeah. Except for the shorts, unless you're short something.
I'm short ITB, guys. Full disclosure.
At the beginning.
At the beginning, yeah.